Over the last few weeks, we mapped almost the entire AI ecosystem. It included power, semiconductors, memory, networking, hyperscalers, enterprise software, and robotics. I discussed 22 businesses, 7 layers, and one question running underneath all of this: which of these are actually worth owning, and at what price? Well, today I'm answering that. Not just which are the good businesses, but what I believe are the 5 best AI stocks from everything that we've covered, ranked by conviction, with the actual price where I would be a buyer at. Welcome to The Quality Investor. Before I get into the 5, I want to address 2 names that I portrayed as truly great, but you won't see them today: NVIDIA and Intuitive Surgical. Here's how I arrived at this list. Every one of these 5 fits one of 3 patterns: a pure toll booth that gets paid regardless of who wins in AI, a straight-up monopoly with no real competitor, and businesses that straddle multiple layers of the ecosystem at once, compounding through more than one growth engine. Arista Networks and Google are the toll booths, ASML is the monopoly, and Broadcom and Amazon straddle multiple layers. Broadcom plays in the semiconductor and networking space, and Amazon, they play in the hyperscaler and robotics space. But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market. Now, NVIDIA doesn't make this list, and this is the reason why. While I said NVIDIA has one of the strongest competitive advantages in AI, with their AI chips and CUDA software, right now, NVIDIA is the single most obvious AI pick that exists. Everyone already knows the thesis. Everyone already owns it. And I wanted this video to discuss the names that will benefit as much or even more than NVIDIA. If you have watched the videos in this series, all are linked at the end, by the way, then you know my feelings about Intuitive Surgical. It is a great business that I proclaimed as one of the top businesses on my personal watch list in the AI robotics video. In fact, I even put my money where my mouth is and opened a small position once ISRG fell to about $400. But Intuitive Surgical doesn't actually fit the thesis of this video. It's not a toll booth on the AI build-out the way that these other 5 are. It's a razor and blade healthcare compounder with its own moat and its own category. The pattern across the 5 businesses you will see today is straightforward. These are the toll collectors. Every one of these 5 businesses gets paid regardless of which AI model, which startup, or which frontier lab ultimately wins the race. Amazon and Google rent out the compute infrastructure. Broadcom and Arista Networks build the connective tissue every GPU cluster depends on. ASML is the single choke point the entire chip industry has to pass through. None of these companies need to predict the future correctly. It is my belief that within the entire AI ecosystem, these are the safest, least risky plays that will compound and outperform the broader market over the next decade. Before getting to what the actual buy prices are, I quickly want to review the 7 layers that I was talking about. You see on the bottom layer, the foundation, this is the power and energy, the bottleneck on the picks and shovels for electricity. And here we have Constellation, GE Vernova, and Eaton Corp. The next layer is the semiconductors. These are the undisputed monopolies of AI compute. In this layer lives NVIDIA, ASML, and Taiwan Semiconductor Manufacturing. And the layer above that is memory. Now, this is a brutally cyclical layer. It is also the most recent AI video that I did. And right now, only one name is worthy of consideration for long-term compounding, and that is Micron. I also discussed Western Digital, Seagate, and SanDisk. But I believe all of those are going to be ensnared by the cyclical nature of the memory business. Right above memory, we have networking, the toll booths connecting the GPU clusters. And here we have Broadcom and Arista Networks. In that particular video, I also mentioned Cisco, but Cisco was a bit late to the party when it comes to the AI build-out. They never really got in on the entire data center build-out, the hyperscalers sinking all that money into the GPU clusters, but they're hoping to capitalize on their legacy enterprise clients, refitting their entire organizations to enable AI there. And right above the networking, we have the hyperscalers. These are the landlords of compute. These three businesses right here control 63% of cloud computing. And that is Amazon, Microsoft, and Google. To me, these are the easiest plays. And above that, we have the enterprise SaaS layer. These are 4 SaaS businesses that I believe the market wrongly assesses right now. And they're actually going to benefit from AI because they're truly systems of record. If you're going to be a successful SaaS business in the AI age, the place you want to be is a system of record. Watch that video for more details. But this includes Intuit, Oracle, Workday, and ServiceNow. And then finally, we have robotics. And this is where AI meets the physical world. And the 3 biggest businesses in this space, at least investable businesses today, are Amazon, Tesla, and Intuitive Surgical. Tesla, by the way, is a speculative bet because none of their robots are actually operational. Both Amazon and Intuitive Surgical have robots that are operating in their core business. Arista has a wide software moat and is behind a huge share of all the AI GPU clusters. When Ethernet had to be upgraded to match NVIDIA's InfiniBand performance, Arista's EOS operating system became the default choice for hyperscalers to build their AI networks around. The hardware is increasingly commoditized, but it is the software where the moat lives. Every deployment makes that moat deeper through real-world feedback into their EOS system. Arista Networks closed at $164.10. Just looking at their PE ratios, they are a bit more expensive than their 5 and 10-year averages. Going forward, I have revenue growing for Arista Networks at 15.7% on the bear case, up to 20% for the bull case. That is on an annual basis over the next 10 years. And I have free cash flow growing at 8.8% on the bear case, up to 17.4 on the bull case. This will give us a bear DCF price of $144.34, up to a bull price of $275.74. Their exit multiple sits at $169.62 and is based on comps of SanDisk, Western Digital, Seagate, Cisco, and Marvell Technology. Without any margin of safety, that's a buy price of $192.51. I am using a 20% margin of safety for Arista Networks. This does factor in the downside risk of data center build-outs turning in-house for their networking stack, but with a 20% margin of safety, that's a buy price of $154.01, a forward PE of 47.8. So anything under $155 at the moment, I think is a great buy for Arista Networks. ASML is the only company on earth that manufactures EUV lithography machines. This is the equipment required to print the most advanced chip circuits. Basically, they are the market. Every advanced AI chip, regardless of who designs it or who fabricates it, ultimately depends on a machine only ASML makes. ASML closed the day at $1,883.11. As you can see, they're also well above their 5 and 10-year averages when it comes to the PE. And this is pretty expensive for a business like ASML, which is in the semiconductor equipment space. We don't typically see PEs get this high, but the AI build-out has really pushed certain valuations. Over the next 10 years, I have their revenue growing at 9% on the bear case, up to 14.5% on the bull case. And that free cash flow, I have that growing at 10.2% on the bear case, up to 19.34% for the bull case. This would lead to a bear discounted cash flow price at $1,012.12, up to a bull price of $2,033.56. ASML does pay a very nice and growing dividend. I have that dividend growing from 12 to 15%, and that would give us a bear dividend discount of $728.72 up to a bull dividend discount price of $1,276.73. Their exit multiple sits at $2,400.33, also a bit high due to the fact that their comps are Teradyne, KLAC, Lam Research, and Applied Materials, all businesses have really been on a tear over the last year. So without any margin of safety, that's a buy price of $1,582.50 for ASML with a 10% margin of safety. And this is a monopoly, so I believe a 10% margin of safety is appropriate. That's a buy price of $1,424.25, a forward PE of 40. So they would have to come down in price quite a bit before becoming a reasonable stock to buy. Google comprises a piece of the hyperscaler triopoly, plus several other goodies that most investors underweight. This includes Google Cloud's growing share of AI workloads, Gemini's distribution advantage across billions of existing users, the YouTube growth engine, and even a long-term bet, which is Waymo. The Waymo bet, however, is not priced into my valuation. The cash cow that is search still funds all of it. Google closed at $353.55 today with a PE ratio of 27. That sits right in between their 5 and 10-year average and their forward PE of 26.4, just a bit higher than their 10-year average. Google's valuation summary looks a little bit different because I've not updated it into my new template yet. However, their revenue growth over the next 10 years, I'm projecting at 7% for the bear case, up to 12% for the bull case, as well as free cash flow growth of 13.5% on the bear case, up to 23% for the bull case. This will give us a DCF bear price of $241.27 and a bull price of $508.21. Google just started paying a dividend. I'm projecting that dividend growth to be anywhere from 6 to 10%, and that would give us a dividend discount bear price of $154.45, up to a bull price of $354.16. Google has a exit multiple valuation of $364.65. That is based on comps of Meta, Microsoft, Apple, and Amazon. So without any margin of safety, that's a buy price for Google right now, $331.68. And just last week, they were right down in that area with a 10% margin of safety. And I believe that Google is one of the safest and most reliable businesses in the market. So with a 10% margin of safety, that's a buy price of $298.52 and a forward PE of 22.3. So as you can see, anything under $300, I think Google becomes a buy again. They were trending downward for quite a while here, but had a bit of a bounce back in the market today. Broadcom sits on both sides of the AI infrastructure trade. They have custom ASIC chips powering Google's TPUs and Meta's MTIA silicon, and the networking chips inside the majority of high-end AI Ethernet switches. The co-development relationships with hyperscalers, these take years to build, and they create switching costs that are extremely difficult to dislodge. Broadcom, another business like Google that's been on the slide recently, they closed today at $372.45. Their PE ratio is pretty high right now at 62.1. Both of their PEs here are well above their 5 and 10-year averages. Over the next 10 years, I'm projecting revenue growth of 16.8% on the bear case, up to 23.7% on the bull case. A lot of that revenue growth is front-loaded into the next couple of years, however. And ultimately, I'm projecting free cash flow growth of 13.26% on the bear case, up to 23.16% for the bull case. This will give us a bear DCF price of $309.76, up to a bull price of $681.36. Broadcom also pays a very healthy dividend. I have that dividend growing anywhere between 10 to 14%, and that gives us a dividend discount price of $355.53 on the bear, up to $608.41 on the bull. The exit multiple sits at $390.33, and that is based on comps of NVIDIA, Micron, Advanced Micro Devices, Texas Instruments, Marvell Technology, Qualcomm, and Analog Devices. Without any margin of safety, that is a buy price of $454.27. With a 15% margin of safety, that is a buy price of $386.13 and a forward PE of 48.6. I believe a 15% margin of safety is appropriate for Broadcom. They do have a lot of customer concentration, and a lot of their AI revenue does depend on these hyperscaler relationships. But nonetheless, anything below $385, I think is a very good buy for Broadcom, and I actually added a lot of Broadcom to my own portfolio in the last couple weeks. Amazon is my highest conviction pick on this list, and they show up twice across the AI layers. Once as a hyperscaler and once in robotics. AWS remains the largest cloud platform on Earth, and separately, Amazon operates the largest deployed fleet of operational robots in the entire world, with a clear, quantifiable margin expansion story as that automation scales. This is two compounding growth vectors inside of one stock, with the retail business as the cash-generating floor underneath all of it. Amazon closed the day at $240.14. They have a PE of 28.7, well below their 5 and 10-year average. So Amazon, historically, is looking a little bit cheap. They're producing negative free cash flow right now, so it is difficult to gauge what their free cash flow growth here is. And again, this is not updated for my new template here, but the revenue growth I'm projecting over the next 10 years is at 8.7 for the bear case, up to 11.22% for the bull case. And in lieu of the free cash flow growth, my projected free cash flow margins are 11.46% for the bear, up to 20.25% for the bull case. This will give us a DCF bear price of $188.74, up to a bull price of $419.56. Amazon pays no dividend, but they do have an exit multiple at $260.86 based on comps of Walmart, Netflix, Microsoft, Alphabet, Salesforce, and Oracle. So without any margin of safety, Amazon right now has a buy price of $284.58, but with a 15% margin of safety, that's a buy price of $241.90 and a forward PE of 34. I actually used to have a 20% margin of safety for Amazon. That was largely based on their propensity to go negative in free cash flow, but once I wrapped my head around AWS, the margins there, and then how they were expanding the margins in the retail, Amazon just became that much more of a reliable business. So I believe a 15% margin of safety is appropriate, and anything under $240, Amazon is certainly worth scooping up. These are the 5 businesses, all of which are toll collectors on the AI build-out. If you only remember one thing from this entire series, the best AI investments are the ones involved in the most boring aspects of AI. They are AI model agnostic and make money based on the usage of AI in general, rather than any one niche aspect. This makes them reliable and safe investments that will outperform.
Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.